You're staring at the charts, rubbing your eyes. You've got a gut feeling about where the euro is headed, so you take the trade. And then you watch, helplessly, as it moves entirely against you. This is where most intermediate traders get stuck. You win one trade based on a hunch, feel like a genius, then lose the next two. Jump to a new indicator, try a different time frame, and start the chaotic cycle all over again. Compare that to how a casino or an institutional trading desk operates. They don't rely on intuition, and they definitely don't stress over a single losing hand. They run a systematic assembly line of pure mathematical probability. A professional trading edge is a strict, measurable mathematical formula that dictates your exact probability of profit. To stop hemorrhaging capital, the guessing game has to end. Long-term success requires building a statistically robust business. The engine of that business is a concept called expected value, or EV. EV is the average amount of money you can expect to win or lose per trade if you executed the exact same setup an infinite number of times. This formula on screen shows us exactly how to calculate it. You take your win rate, multiplied by your average winning amount, and subtract your loss rate, multiplied by your average losing amount. Watch how these numbers update. Let's say you have a seemingly poor win rate of just 45%, but your average win is $300 and your average loss is kept to a strict $100. Plug that in and your expected value is a positive $80. Every time you take a trade, you are statistically expected to make $80 over the long term. But then reality hits. You execute your mathematically sound strategy and you lose 5 trades in a row. The immediate psychological urge is to abandon the system because it feels broken. This chart illustrates why you must hold your ground, a concept known as the law of large numbers. If you flip a coin 10 times, you might get 7 heads. It looks chaotic. But flip it 10,000 times, and the results converge perfectly on a 50-50 split. Short-term randomness gives way to long-term predictability. 10 or 20 trades is statistical noise. To prove your edge is genuine, you need a minimum sample size of at least 100 recorded trades. Once you calculate a positive expected value and deploy it across a massive sample size, the emotional sting of a single loss disappears. You aren't just hoping for a single win anymore. You are simply waiting for the underlying math to play out. There is one catch. You have to survive long enough to actually reach that 100-trade threshold. If you risk too much up front, a normal losing streak will wipe out your capital before the math can save you. Take a look at this bar chart demonstrating fixed fractional position sizing. You strictly risk only 1 to 2% of your total account on any single trade. If you hit a losing streak and your balance drops, your 1% risk dynamically shrinks, automatically protecting the capital you have left. Before you risk a single real dollar using that sizing model, you have to run a historical backtest. This means applying your strict entry and exit rules to months of past market data, confirming the strategy yields a positive expected value. Cautionary, but avoid the trap of over-optimization or curve fitting. If you tweak your parameters endlessly until they perfectly predict historical data, you end up with a mess like this. A strategy tailored perfectly to past data will completely fracture the very second it hits unseen, highly volatile live market conditions. To prevent that, you move to forward testing. You trade the strategy on a demo account for a few months. This proves your edge functions in current market environments, not just in hindsight. Both your back testing and forward testing must account for real-world operational costs. If you aren't factoring in broker commissions, spreads, and slippage, the gap between the price you expect and the price you actually get, your expected value is a fiction. Ruthless backtesting proves the edge exists, and rigid position sizing ensures you survive to use it. Together, they form a shield that protects your math from real-world market chaos. With protections in place, your mindset transforms. You are a system operator. A loss trade is a standard business expense to keep the machine running. The math does the heavy lifting, but the market is a living ecosystem. Your mechanical rules require a layer of human contextual awareness. When major news hits, like an FOMC interest rate announcement, volatility becomes entirely unpredictable. The smart move isn't to guess the outcome. You simply pause your automated strategy until the chaos subsides and normal statistical conditions return. macroeconomic conditions shift over time. Make it a habit to review your statistical baseline every quarter. Check your win rate and your average risk-reward to ensure your system is adapting to the current environment. Combining mathematical rigor with institutional-grade tools is how you achieve consistent profitability. Head over to FXNX to utilize our advanced backtesting tools, leverage 0.0 pip spreads to minimize your trading costs, and open a demo account today to start calculating.